Show my screen. Okay. Previous session, we talked about the corporate tax. And what we talked about the structures of the business, how the business are structured. We talked about it that we have four different business structures in Canada: the sole, the corporation, and the partnership and joint venture. Then we talked about the different taxes structure. We talked about that the partnership and joint venture, they don't have anything to file. The sole are just filing the personal tax. And in the personal tax, I explained that about that form T2125. That is like an income statement for the business. And then we talked about the corporate tax. And this is that we need to file a T2. Then we talked about that level of the sole, and we talked about that we can deduct expenses for that one. Then for the corporations, we talked about that we have public companies that are traded publicly, and then we have private corporation. Whatever is not a public company is a private corporation. And then we have the if a private corporation is mostly owned by Canadian tax residents, then it's called the Canadian Controlled Private Corporations, or CCPCs. And then we talked about the attributes of having a corporation. We said that, we can enjoy a lower tax return, tax rates, enjoy the perpetual existence beyond the life of the owner. We talk about that it can possess the rights, it can rent a place, lease a car, all those stuff. They can own property, like the individual. They can carry business as we expected that one. Anything that is in the corporation, we are protected from that one. And if there's someone wants to sue a business, they're gonna sue the corporation, not us. And then at the end, it's unlike the sole, it can have unlimited number of owners. Then we talked about the structure. We talked about it that if you the traditional structure is like that one: owners own a corporation and the corporation does business with the public. So if someone wants to sue the corporation, they will have access to all the money that are earned in the corporation. But if we can transfer that one and make it like this one, it's a holdco-opco structure. In the holdco-opco structure, the owner owns the holding company, and then the holding company owns the operating company. So in this structure, whatever the operating company makes, it goes up to the holding company as a tax-free dividend. And then if someone from the customers wants to sue the corporation, they're going to sue the operating company, and the operating company has no assets in there because all the assets are in the holding company. So in this structure, we added an extra layer of protection here. And okay, hold a second. We add an extra layer of protection, that is this operating company, and all the money, all the cash that we have is going to be in the holding company. It's going to be kept in the holding company. So we're going to have much less tax liabilities. So, and sorry, much less legal liabilities. Then we talked about the corporate tax. We talked about it that unlike the individual tax, in the corporations, technically we have three different buckets. The first bucket is for the active income. And we talk about it that the first $500,000 net income that we make is taxed at 11%. Then the rest, anything over that $500,000 is going to be taxed at 27%. In BC, it differs from province to province. Then we talk about it that if we have passive income, like rent, and we explained that one. We have rental income, interest, dividend, royalty, and 50% of the capital gain. So if you have rent or any passive income, they're going to be taxed at 50%. And then the last bucket is the tax-free bucket, which is called the capital dividend account, or CDA. Any money that goes into this bucket is tax free, and the corporation does not need to pay any tax on that one. So, and then we talked about that after we pay the corporate tax, we want to take out the money on the individual side. So we have three options. The first option is the salary. When you pay salary on the individual side, it's 100% taxable. And you have to pay the CPP, which is almost 12%. Then the other option is to give the owner a shareholder's loan, which is all tax free. But what will happen is that it's tax free when you get it, but you need to return it in less than 2 fiscal years. By the end of the next fiscal year, let's say that the fiscal year is end of December, so you get the money in June. For example, in June 2025, you get the money. So you have time till December 2026 to return the money. So you have 1 year. So no tax, no CPP for that one, no tax for it. And but you need to pay interest to the corporation. If you don't pay the interest, then the CRA will come and just said that, you need to add this interest to your personal income. The last option is the dividend. Dividend is paid from the after-tax money. So salary is paid from the corporate before tax money, but the interest is paid from after-tax money. Sorry, the dividend is paid from after-tax money. So the corporation has paid the tax, and now we want to take out the dividend. So if we pay more tax in the corporation, we're going to pay less tax on the individual side. And if we paid less tax in the corporation, we're going to pay more tax on the individual side. And if the money was from the tax-free resources, from the CDA, then we don't need to pay any tax. And it's called the capital dividend, and it's going to be all tax-free. So is there any questions so far? Nothing? Great students. I like you. So now, what comes to the mind? The first thing that a lot of people, I want to talk about the tricks that people feel that they can do with the corporation. The first thing, imagine that we have a person who makes $200,000 as an employee. So the first thing that comes to the mind is that I can go and talk to my employer. He's my friend, she's my friend, and I will invoice him from my corporation instead of getting a T4 from the guy. So what's the attribute? No CPP, no personal tax, all is going to be corporate tax. And the corporation is going to collect the money. So in this case, the employee is happy. Why? Because they don't pay that much of tax, no CPP, no EI, nothing, which is great. And the employer is happy as well. Why? Because they don't need to pay the CPP and EI portion of the salary. So they are technically saving almost 7.68%. So both sides of the deal are happy. Who's not happy? CRA is not happy. So when CRA is not happy, no one can be happy. This is the rule. So they made a specific rule that is called Personal Service Business, or PSP. So PSP applies when a person incorporates the employment, or it's called like the incorporated employment. So if that person owns more than 10% of the share, and when you review the the description of the contract and anything that they have with the corporation, that's reasonably is considered as an employee. And you know, there are some Supreme Court cases about that one that they explain that how a person is considered an employee or a contractor. So if the person is reasonably based on those rules considered as an employee, then if they invoice the corporation instead of getting salary from the corporation, then they will be covered under the personal service business. This corporation is called the personal service business corporation. In this case, some serious consequences happens. The first thing is that forget about all those 11%, 27% tax rates. The CRA is going to charge 33% on the federal level plus 20% on the provincial level is 53% tax. The corporation has to pay 53% tax. Why? Because it's a PSP. Then the next one is that so there is no small business deduction, nothing for 11%, 27%, forget about them. And they cannot deduct even expenses. In the corporation, you can deduct a lot of expenses, but when that corporation is considered a personal service business, then you are not allowed to deduct a lot of expenses. The only expenses that you can claim is first the salary of staff, employees that you have, costs associated to the benefits provided to the employees, employees and their costs, and expenses allows as an employee, like technically they are recharacterizing your income as an employee. So if as an employee you are eligible to deduct some expenses, you can deduct it here. And the other thing is about the expenses that you legal expenses incurred in collecting fees, collecting the invoices. So in general, you cannot deduct the car lease, you cannot deduct the rent. A lot of these stuff, they are not deductible. So this is a very serious consequence. What will happen is that if that company has more than 5 full-time employees, and they should be non-related people. So if they have more than five full-time employees, then they will not be considered as a PSP and they can use all that 11, 27%. They will be taxed as normal people. So in general, if you work for some places and you're friends with the employer, do not think that you can incorporate and invoice the corporation instead of doing that one. Is it clear? No, you cannot save on your taxes unless the CRA wants to let you do that one. Okay. So is it clear? No question? Okay, good. So the next thing that I want to talk about it is about the investment. You remember we talked about the investment passive income in the corporation? If you earn passive income in corporation, you have to pay 50% tax on that one. Unless it's considered as a specific investment business or SIB. A specific investment business means that a business that is designed to do what? To do business, to do investment, to make passive income. Imagine that you have 5 rental high rises. A corporation owns 5 rental high rises. So they need to have in-house accountant, they need to have, their own repair and maintenance person, they need to have a property manager, everything. So in this case, if they have more than 5 full-time employees, then that passive income is no longer passive because technically you are doing stuff to make this money. So it will be considered as an active income. And you can, instead of 50% tax, you're gonna pay 11%, 27% tax on that one. So it's very important to have that five full-time employees. Is it clear? Aside from Sima, anyone else? Is it clear? Okay, good. Wonderful. Now, are you all there? Not sleeping?
Yeah, yeah, Professor.
Okay, because you all have turned off your cameras.
Only me.
I was worried that I'm talking, to some people that are sleeping there. Maybe I'm your sleeping song. Okay, good. Pretty, why your camera is off? Your camera is on. Okay, you're out there.
Yeah,
Okay.
in fact, I'm outside. That's why, yeah.
Okay, no problem. Okay. Yeah. Moni, that's good. You turned on your camera. It's okay if you want to turn off your camera. It's okay. So these two provisions, they are for the corporate taxes. So, you cannot outsmart the CRA. Do not feel that okay, I understood that one. I can make it. I can trick the CRA. You cannot. Don't do that one. Don't mess around with this stuff. They're gonna be very serious, and they're gonna be very hard when they come back for that one. So the other great idea that comes to the people's mind is that okay, I cannot incorporate my employment. I have a business and I have incorporated that one. But I have a child. My child doesn't work. So his income is pretty low. I'm gonna pay him or her, and then that person is gonna pay the taxes. Or my spouse is, doesn't have that much of an income, so I'm gonna pay them, and then they're gonna pay lower taxes. So it just imagine, Zora, you make a corporation and you pay $20,000 a year to Ava. So it's just like a salary that you pay to your daughter. In general, if you do this kind of creative stuff, make this little child or spouse the owner, or make them the employee and pay them unreasonable amount, then this will be applied. This is called the tax on split income, or TOC. This is a huge thing here. If your income is categorized as TOC and TOC applies there, then you have to pay on the individual side. For example, Zohra, you paid Ava $20,000 from your corporation. Ava, on her personal tax return, has to pay 33% federal tax plus 20% provincial tax. It's 53% tax. So the person who has collected this income has to pay the highest tax rate. So they make it very high rate to kill the motivation to take this risk. And this one, the scope of TOSI, it applies to these paying dividend to the spouse, paying salary and or dividend to the spouse, and paying dividend or salary to the children under age 18. So if you do any of these stuff, you should be very careful that TOSI may apply there. I have a client, the guy owns a drugstore, a pharmacy. And then he paid his son $15,000 a year as like a scooter delivery person. And the CRA assessed that one and they classified that one as a TOSI. Poor son has to pay $7,000 taxes on $15,000 money made. Almost $8,000 technically. No, this is how strict CRA is about this one. So, is there any question here?
Yes, may I have a question?
Sure, go ahead.
So we know that many families here have a business, like a small business for themselves. So this rule, if this rule applies to all of them, it's not making sense to, like, for spouses to work together.
Yeah, You know, the main thing is that the amount that you pay should be reasonable. And that person should actively be involved. For example, let's say that you have a trade company. So in your company, you trade Bitcoins, all this stuff. So you cannot say that my spouse is my admin
Right.
and pay him, you know, $200,000, $50,000, $60,000. Because, you know, there is no rule for admin in a company that is a single-owned personal business.
So it depends on what they do. Like if they have a
Yeah.
bakery and they say my wife is here all the
Yeah.
time,
You
does
know,
that make
yeah.
sense to them and it doesn't apply to them?
No, it doesn't apply to them because
Oh,
they are actively involved there.
so it depends on the nature of what they do.
Yeah, exactly.
Okay,
And
got
they
it.
will assess that one. But, you know, for kids, especially for the kids under age 18,
Mm-hmm.
they are pretty nasty about that one.
Right. Okay, got it. Thank you.
Yeah, okay, no problem. So anything else? Any other questions? Is it clear? Wonderful. So the next thing that we want to talk about it is a good side of having a corporation. Whenever you own a corporation, you build a business in the corporation. So in general, this corporation, if you sell the shares of that corporation, so let me just explain it here. You are here, and then you are the owner of this corporation. And now you have built a business here worth $2 million. How much money you put in? Zero. So now you want to sell it. So you have some assets here that they are working, sets of machineries, everything, brand, customer list, everything. Sometimes you can sell these assets. That is majority of times the buyers, they want to buy the assets. But sometimes someone came in and they said that, you know, I want to buy the shares of this corporation. So I want to become the new owner and you will no longer be the owner of the corporation. If you dispose the shares of a CCPC, and it should be a qualified small business, that I'm not going to jump into the details of that one. So in general, if you sell the shares of a Canadian controlled private corporation that is active, then up to this number has changed. It's now $1.25 million. $1.25 million of the capital gain that you make is going to be tax-free. So, for example, you have $2 million is the value of the company. So you sell your shares and this guy pays you $2 million. So this money that you get is called proceeds of disposition, POD. So a POD for this transaction is $2 million. Okay? Then the money that you have spent to build this business is called adjusted cost based. Let's say that you have spent $100,000 of your money cash. You know, you have built the business from scratch based on, you know, the all the efforts that you put into that one, the time and everything. Those are not count. Just the cash, the money that you paid to build the business is $100,000. So how much is the capital gain? The capital gain is $1.9 million. The difference between the POD and the ACB. So ACB stands for adjusted cost based. So then if you sell these shares, they're going to say that $1.25 million of this is not taxable. It's going to be tax free. So only $650,000 of the capital gain is taxable. Now, it's half of it is taxable, another half is not taxable. The taxable part pours into your bucket. You remember the individual tax bucket. So $325,000 goes here. Another $325,000 is tax-free. You don't need to pay tax on it. So you see, out of $1.9 million of capital gain, you pay tax only on $325,000. So it's a great feature for building your own business. It helps you that to build a business and get tax-free money for the efforts, for all the times and every time and sweat that you made for that business. You're gonna get paid tax-free money up to how much? This is $1.25 million plus 3.325. It's 1.57, something like that. So $1 million is going to be tax-free for you without paying any tax. So is it clear? Does that make sense? So it's good to build a business and build a corporation for yourself. Why? Because you can get this lifetime capital gain exemption. So it's like a TFSA for your own corporation. Because in the TFSA, if you put the money into others' corporation, it's going to be tax-free. So in your case, if you own a corporation, the money that you put into that one, up to $1.25 million is going to be tax-free. And okay, good. So this is mostly the basic stuff about the corporate tax. And I want to explain another thing about the corporate tax, which is called, so it doesn't let me write down. Double tax trap. What's the meaning of double tax trap? It happens when a person that owns a corporation passes away. So I will explain that one into the estate planning. I think in the next week we have the estate planning for that one. But in a short term, that's just like that one. Imagine that a person owns a corporation. This is the corporation for that person. And then they have built, I don't know, $2 million cash in the corporation. Okay. So if the person wants to take out the money, they have to use this money as a dividend. And he has to pay dividend tax. So this person doesn't take out the money. Okay. So no dividend tax here. Then the person, God forbid, passes away. Now, this share will go to the person's estate. I'll explain it in another session. Now, the person is no longer the owner, but the state is the owner. And they assume that the person has sold the share to the estate. So $1.25 million is tax-free because of the lifetime capital gain exemption. And this person, the final return of this guy, has to pay tax on, $750,000. Now, this estate, it goes to the kids or the spouse or anyone who is the beneficiary of the person, the heirs, let's say. Now, they want to take out the money. Now they own that corporation. So now they want to take out the money, so they have to pay themselves dividends. Make sense? So they have to pay dividend tax as well. And they have the capital gain, paid the capital gain tax here, a dividend tax here. So you see, this one money is taxed twice. So that's why it's called double tax trap. If a person owns a corporation and the person passes away, the money that is in the corporation will be taxed twice. And double taxation in Canada is not allowed, general rule, but for this case, the CRA will love to get that money. So you need to have a plan. If you talk to people who owns corporations, always raise this conversation with them. Because if the person passes away, then the whole money that is inside the corporation will be taxed twice, as I explained here. If you don't feel comfortable with this part, it's okay. We're gonna explain it in the state and final tax. So, are we good so far? Great. So, I want to give you an example and finish with one of the give you a preview of one of the services that we provide as financial advisors. Are we good? Interesting. So imagine that we have a person, this person here, let's call it Mr. A. Mr. A owns a corporation. And on the personal side, Mr. A has a marginal tax rate of 40%. Do you remember what was the marginal tax rate? What was the marginal tax rate, Zora? You forgot about it. Okay, no problem. Marginal tax rate is the highest tax bracket that you pay tax on it. So now if your tax bracket is here, your income is $100,000, for example, the last bracket is at 43%, for example, let's say. That 43% is called your marginal tax rate, the highest tax bracket. So it means that any extra penny of money that the person makes is going to tax at 40%. Mr. A, if the person makes $1,000, he has to pay $400 taxes. So now let's say that Mr. A was smart enough and built a holdco-opco structure. And in the holdco, in the operating company, sorry, he has built, let me make it smaller. He has built, oh, this doesn't work. This doesn't work as well. Okay. The money that they make, the revenue is $700,000. All the expenses is $400,000. A part of it is his salary. So how much is the income before tax? It's $300,000. How much tax they should pay on it? 11%. So it's less than $500,000. So they have to pay $33,000 tax. How much is the remainder? $267,000 left. They transferred this money here, $267,000 here as tax-free dividend. Make sense? So far, it's only this money is taxed at how much? 11% tax. No more extra tax. Now, let's say that the guy this Mr. A likes to buy real estate. Wants to buy a rental property. Like a lot of people here, he's excited about buying real estate. So what he would do, we will explain it in 3 different scenarios. Scenario number 1 is that he used that money, this $267,000, and buys the property inside the corporation. Okay? Let's say that the rent from this is $20,000 a year. So after all the rent that they earn minus all the expenses, the bottom line is $20,000. So how much tax he should pay? Do you remember the passive income tax? In the corporation, rent was a passive income inside the corporation.
Only
So
7%?
no, it's a passive income. So if you check that one here, passive income
Oh,
in the
it was
corporation
53.
is at
50 something.
50% tax. So he
Yeah.
has to pay $10,000 tax. Okay. Now, how much is the remainder? $10,000. Now he has to use this money, follow this black line here, and pay himself dividend on the personal side. Now, on the personal side, he has $10,000 dividend. Is it clear? Now he has to pay personal tax on it. Personal tax technically it should be 40%, which is $4,000. But in this case, they're going to pay about $3,000 tax. I'm not going to explain all the details of that one. So he's left with how much? With $7,000 in his pocket. Okay? Is it clear? Now, let's say that he has this property, rental property, on his personal side from the day one. So how much income he made? $20,000. How much tax he has to pay? 40% of that month. Yeah? So $8,000 goes for taxes. So how much is the remainder? $12,000. So you see the difference? If he buys the property inside the corporation, he's gonna earn almost $5,000 less, which is almost 40% less. So it's not a good idea to buy the property inside the corporation. So he says that, okay, I won't buy the property inside the corporation. What I will do, I will use this money, this $267,000, and pay myself what? Dividend to buy it on my personal side, because the intention is to buy it on the personal side. So he makes $267,000 personal income as dividend. How much tax he has to pay? Almost $100,000 will go for tax. Make sense? 40%. So he's left with how much? $167,000. Now, he's not able to buy that property. He has to use it to buying a very smaller property. So much less, what? Much less taxes, much less money, much less rent, and he has to pay a lot of taxes. So this scenario doesn't work as well. Let's look into another scenario here. So let's say that we put this $267,000 in a mediator and then take that money like a loan on the personal side. Now, it's a loan. How much tax we should pay? Any idea? 0. Because it's a loan, it's not an income. So how much does it have? $267,000. Now with this money, he can buy this property and have this money. Make sense? This mediator is something that's called the whole life. And I will explain it later in our other class about life insurance. It's a life insurance product. And it's something that we can offer to the corporate owners and save them a fortune with the taxes that we save for them. So I'm not going to jump into all the details of that one, but it's a very small service that we can provide. It's one of the services. We have a lot of these kind of services in our business. This is one of those services that we can provide to the corporations and help them to save a lot on their taxes. Does that make sense? So if you want to have access to the knowledge about this one, all this stuff, go get your license. Yeah, that's good. So let's keep it here. If you have any question, please shoot.